we usually like spend 5 minutes before the start of actual event, like discussing all sorts of casual stuff. So basically, how the things, maybe this time they're not going to be so casual. So how the things are going at GP, especially what's interesting probably the sentiment about potential sanction risk given all the events and attitude to Russian market because of that. Anything, it's outside the scope of today's subject, but since you are a CEEMEA specialist, probably you can offer some views.
I'll do the shtick on global stocks and whatever, and then as soon as I'm done with that, ask me a quick sanctions question, and then we'll take the Q&A after the sanctions. Is that okay?
Okay.
Or you want to start with sanctions? Or do you want to start?
No.
Okay.
Whatever is more comfortable to you. So,
yeah, let's do the global and the US stuff first, and then we'll talk sanctions.
Okay. Because here is like what people actually, especially market people, fear the most.
Yeah.
Because otherwise the fundamentals are pretty much strong, and so people are not worried about the fundamentals here. And for the first time, people are not scared of inflation, which used to be like problem for the ages. Okay, guys, colleagues, there I think I see there is more and more people are joining us. So let me slowly start. Let me remind you that we are very strict about our time limits. So we start exactly at 7:30 Moscow time, and we finish exactly at 8 p.m. Moscow time. And this is our actually, this event is fully in English, so hopefully everyone understands. But again, for market professional, for finance and investment business professional, English is a must-do language. Even though Дэвид Азеркофф, I saw it on your CV, you used to work for Renaissance Capital. So you're based in Moscow and London.
I was a little bit of both, back and forth.
Okay, so you probably know a couple of words in Russian, I bet.
Yeah, there are three. When I was in Moscow, there were 3 sets of taxi prices: local, foreigners who could speak enough Russian to haggle, and foreigners. And I was in the second category, so I know enough to haggle with a taxi driver, but not enough to explain global markets.
I understand. So again, everyone, we have 2 minutes to go, and let me introduce to you David. David, excuse me, not knowing how exactly to pronounce your surname. Can you please tell it so I don't?
Azerkофф.
Azerkофф. So David Azerkофф, he is the executive director at JP Morgan. He specializes in EMEA, and he's #1 in institutional investors in his category. So whoever is into this stuff, he knows what it means and how much value investors assign to these votes, and how like analysts respect it for that. So we're very lucky to have him today. And he'll be speaking about US and global markets for us. And later we have some Q&A. Since we have a lot of people today, we will have everyone muted. So after David's speech, please write your questions in the chat, and I will read them for him. And hopefully we'll be able to cover most of the stuff that we'll have there. So it's time. David, your turn.
Okay. Well, first of all, thanks very much, Pavel, for inviting me. It's an honor to be addressing a group like yours in Moscow. There are really a few things I want to touch on around the global background. And then once we get through those, then I think the implications for US and global equities will become pretty clear. So I'm going to start by talking about where do we see global growth, where do we see global rates and global central banks, a little bit on how do we think about COVID and COVID risks, and then we'll get into markets, stocks, sectors, all of that. And then once that's done, hopefully that will be 10 or 15 minutes. We'll go to Q&A and we can talk about anything else anybody wants to talk about, and whether that's Russian stocks and sanctions or anything else, I'll be all yours. So first, where are we in terms of global growth? Really, what we saw in the second quarter of the year was this massive drop, and what we're seeing in the third quarter is this massive rebound. And the numbers get a little crazy, and I think they're a distraction. What we really need to focus on in terms of thinking about global growth is, where do we exit 2020 global GDP relative to where did we start the year? Essentially, once we even out the big down and the big up, where do we stand? And according to JP Morgan, we're going to be down about 5% relative to the pre-COVID path of global growth. And so I think what that means is we still need to think about global markets, not so much as a recovery trade, but as a story where essentially the global output gap remains wide. And so when we take that global growth story and then start thinking about inflation, for us, our economists are pretty well convinced that inflation is a story about the output gap. If we're going to see a wider output gap, we're going to see inflation staying low. And so really what we're talking about is inflation around 1.5% in the US. We're talking about inflation 1%-ish in Europe. And the great fear, I think, that some investors have, that all of the monetary easing will end up turning into inflation, is misplaced. And if you think about the mistakes that people have made repeatedly over the last 10 years, it's making the mistake of assuming monetary growth and QE will automatically turn into inflation. And the reality is that inflation continues to undershoot most central bank and most consensus forecasts. And so for me, I think the story is, I'm not going to worry about inflation until it's much worse than people expect. For the last 10 years, the right trade has been to expect inflation to be below consensus, not above. And we think that story continues. Inflation is a function of the output gap. So that's the story on growth. That's the story on inflation. Where are we with central banks? So I just had a big birthday in July. I had a very significant number. And the question is, when I hit my next significant birthday in 5 years, will the Fed have raised rates? Will the ECB have moved rates above zero? It's a really interesting question. I don't know. But where JP Morgan is forecasting is, we are not forecasting any rate hikes in Europe from the ECB or the Bank of Japan or the Fed as far as we're forecasting. We're forecasting out to the end of 2021, end of next year. And if you poke our economists with a stick and say, what do you really think? They won't commit to a rate hike at any point, no matter what date you give them. And I think broadly speaking, that's where, I think that's where we need to be thinking as investors, that the first rate hike is so far away as not to be very important at all. And I think what that means in terms of global bonds is global yields are going to stay low. So we're sub 1% on US 10 years. I think we stay there. The next Fed rate hike is so far away, we can barely see it. And if you listen to what the Fed Chairman Powell was saying at Jackson Hole, is he was giving us more reasons for staying on hold longer. I think the criticism of what he said is he essentially moved the goalposts in terms of changing the target. He's not going to use any different tools. He's not going to ease faster. But really the substance of the impact on monetary policy of this, we want to run inflation above 2% before we raise rates, really is saying that the Fed's going to stay at zero longer than we thought, longer than we previously thought. And for me, that is at some point in the very, very distant future. And that means global bond yields stay low. The follow-on, I think, from that in terms of investing is, in the old world where investors typically ran portfolios of 60% equities and 40% bonds, we're going to be looking for more substitutes in that bond portfolio. And whether that's developed market investors moving out of government bonds into high grade or high yield or into EM duration to pick up yield somewhere else, I don't know. But it's clear DM investors are going to be looking at 0 or 1 in their government bond allocation and are going to need to work harder to get the returns they need to fund their long-term liabilities. Briefly on COVID, really, it seems like what we're seeing now is some small ticks up in COVID incidents across Europe and a relatively high level getting slightly higher in the US. It does make us cautious on Q3 and Q4 economic data. And we're seeing that play out, I think, most immediately in the oil market, where our oil team has been bringing down its demand forecasts. And we're really using a lot of big data, a lot of ways to try to look at day-to-day transportation trends to try to get a sense of where economic activity is. And to a large extent, certainly in the transport with a knock-on to oil, it seems to be a little bit disappointing to what we were hoping for, say, 4 or 6 weeks ago. Now, that's the background. What does this mean for global equities? So really, the trends that we've seen in terms of technology leads, gold stocks do well, value doesn't really pick up, we think those trends continue. And so if you listen to our global equity strategist, Mislav Matejka, what he's saying is we want to stick to these tech and growth themes, and we really don't want to play in this value rotation. For what this means on a global basis is US equities probably outperform the rest of the world, not because the US is doing something significantly better, they just have more tech stocks than everybody else. And so that sector allocation probably overrides some of the country or regional themes that investors would normally look to. And so essentially we think tech continues to rally. We think a lot of the other growthy or defensive sectors can continue to do well at the expense of value. And if you listen to our quant team, who are really interesting, what they've been saying is even as US equity indices move higher, it kind of feels like a bear market. The reality is leadership is very, very narrow. The reality is when you look at a typical bull market, you would see things like value leading, you would see growth underperforming. And so we're seeing a rising index level, but we're seeing bear market internals. And so that's sort of their explanation about why does the stock market feel so unusual for a bull market. That's why we're seeing higher index levels on the S&P without getting the kind of bull market across a lot of sectors and a lot of stocks that you would normally see in this kind of performance. So really what we're saying is growth in tech continue. The market that we've seen for the last few months probably goes on. Obviously, this is sort of more of a medium-term view. It's not saying that we won't see weeks like we saw last week where tech does sell off. But really, sort of on a view to the year end, we want to stay long tech and we want to stay long growth. And with that, I'm going to pass it back to you, Pavel, and happy to talk sanctions, happy to talk whatever questions people have, happy to talk US elections. I think, Pavel, you're on mute. Well, let me just pick up the ball here because I know Pavel wanted me to speak briefly about sanctions and where do we think that impacts the Russian market. There are a few things going on, I think, with the Russian stock market. The positives are essentially valuations, and Russia is the cheapest market in terms of dividend yield globally. I think Pakistan's a fraction higher, but come on. Russia is the cheapest real stock market we can see. And those dividends we think are sustainable. Russian companies have, I think, surprised a lot of investors through this COVID panic and the oil sell-off by sticking to their commitments to their dividend payouts. And so I think that's a huge positive that hasn't been recognized in the stock market. The retail inflow story, I think, is something that can go on, given how far local rates have come down. Locals, and we see this globally, whenever you see a big drop in bond yields, locals tend to move out of bonds and out of bank deposits into stocks. And Russian stocks, I think, are offering something in terms of dividends, and Yandex and Sberbank in terms of growth and profitability. I think there's a story there. Also, the CVR tends to keep cutting rates. Inflation tends to be below what they're forecasting, and they tend to keep cutting rates. They might not do that in September, but I think before the end of the year, we're going to get another 25 basis points, and that will help. The issue really is sanctions. And for global investors, global EM investors have been overweight Russia for a long time. Sanctions are a risk and a worry, and they also prevent Russian stocks from getting into other portfolio managers' portfolios. Global investors who aren't EM focused don't want to deal with the headache and the headline risk of Russia because of the sanctions risk. Now, I think recent events will see another round of sanctions, but I think they're going to be narrowly focused on people, not on kicking Russia out of SWIFT or precluding any sovereign issuance. So I think what we're going to see is a few negative headlines on sanctions, but not with any real economic or market impact over the medium term. It will, however, continue to scare foreign investors. It's going to take a while to get through this, but I think ultimately this will be more of a distraction and a buying opportunity rather than something more fundamental.
Thank you so much about this. I probably at the end ask you about if there are any particular insight from your GR team at GP, but for now, let's go back to global markets. Excuse us for some technical glitch, so I couldn't pick up the mic. So the question is, before moving the political question of the US, I have to, from our listeners. But it's very interesting on my side to listen to your explanation of further tech rally, because you basically saying that it's likely to continue, everything stays like that. And the question is, how much is it a bubble with current valuation? This is the second question. And second question, can you imagine that, okay, if we more or less believe that the growth is maybe still like we have a recession, but we're probably bottoming out in terms of COVID, is it likely that at some point in the future, the tech stocks just shade leadership in the rally and start stagnating or even correcting while the rest of the market pulls up? Or if when stock when tech collapses, it will pull down the rest of the market. So what will happen next? Is it a bubble, and can the leadership be changed without broad market pain?
Okay, so is it a bubble? Probably not. And I'll tell you why I think it's not, and I'll tell you why I think it's only probably not. Typically what you see in a bubble is you see big primary market issuance and you see significant misdirection of investment. And I kind of don't think we're seeing that. We're not seeing the IPO mania we saw in the late 90s. We're not seeing the kind of overinvestment in tech and fiber and all of the crazy stuff that went on in the mid 90s. Yes, US tech stocks are expensive, but I don't think we're seeing the sort of spillover craziness that we typically see in investment bubbles. So I don't think we're at a bubble yet. Now, and I think to a certain extent, some of this rotation into tech is a function of two things. First, if we think about essentially, these are DCF stocks. All the values in the terminal value, as we bring down discount rates, as global bond yields come lower, the terminal value goes up. The rate that we're discounting that is going down, more goes into the terminal value. It does make some sense. And the other issue, I think, is in the middle of this pandemic, with the economy as depressed as it is, and I think not only is it depressed, we've thrown a ton of stimulus at it. we're still here. What else are we going to do? If we're not getting returns on bonds and other non-tech and non-growthy sectors seem relatively unappealing from an earnings growth perspective, we all sort of get herded into tech stocks. And so I think it's probably not a bubble, but I wouldn't be like, I'm open to changing my mind. And then what's going to change this? I think it's pretty clear what needs to happen to get this to change. We need to see global growth and global earnings growth spreading out from defensive sectors and tech into the rest of the market. And so we need to be watching for things like earnings revisions and signs of higher capacity use, higher commodity prices, smaller output gaps, GDP growth surprising to the upside, not just one quarter of noise, but getting people to say, hey, 2021 and 2022 are actually going to be good years, not years of clawing back a recovery. So I think that's what we need to see to get that rotation going back to value. I'm not seeing it right now. In terms of how much damage will it do to, like, can tech correct and not drag down the others? I would love to talk to you about how rational markets are and how sensible investors can be. That's not what happens every single time. So I kind of can't imagine we're going to see that leadership change smoothly. So, I mean, I don't think we're going to see another Lehman or another LTCM when we get that sector rotation, but there will be some difficult days where people will want to put on a helmet and hide under their desk.
Thank you so much. Very simple, question. On a scale of 0 to 10, how crazy is Tesla valuation in your view?
On a scale of 1 to 10, I would say a 7 or an 8.
Pretty tough, actually, yeah. Okay, that's very interesting answer and precisely clear. And we move into the politics again, and the question in the chat about outcome of US election, what happens if Biden wins? So, and what the opposite true if Trump stays? So what do you expect?
So I'm old enough to remember the Clinton years, and I'm old enough to remember the Obama years. I started working in New York at the end of the first Bush presidency. And I think there is a prejudice from investors that Republicans are better for markets than Democrats. And my own experience is that the Clinton years were pretty good for a lot of markets, and the Obama years were pretty good for a lot of markets. I think what Biden will offer to markets is a sense of calm and lack of volatility. I think a lot of investors will appreciate that after the nuttiness of the last 3.5 years. So I think that's one element of pretty calm policy making, no more crazy trading on tweets. I think that's a positive. I think we might see some of the premium in the US dollar come out, where we've seen Trump tweet on trade and do things that are anti-globalization. We've seen the dollar come up. We might see some of that reverse in a Biden presidency, but I think what we'll end up seeing is sensible, rational policymaking out of the US again. And I think over the medium to long-term, markets will reward that, even if there's a knee-jerk reaction from some people that, oh my God, top-end taxes are going to go up, or oh my gosh, the corporate tax rate is going to go up. So I'm pretty unworried if Biden wins, and I think we'll see a similar roller coaster market for EM around China-US relationships if Trump wins.
Fair enough, thank you. And a little continuation to this question. How much do you think he will be tougher on Russia than Trump?
Well, so the discussions I've had with people in the US up to, say, pre-COVID, or through the end of 2019, let's say, let's not make this a COVID thing, through the end of 2019. So in 2017, the Democrats in the House and the Senate were really angry and really wanted to punish Russia for the crimes of 2016, or the perceived crimes of 2016. That anger has faded. And so I think if we could get through November elections without Russia being credibly accused of interfering in 2020 elections, I think there would be a sense of letting whatever happened in 2016 stay in the past. If that doesn't happen, then I think you'll see a much more intense reaction from Democrats who might also win the Senate as well as the presidency. So I think you've got that issue to deal with. And then I think where the sanctions on Russia in 14 and 15 were particularly effective is where US and Europe and Japan and Australia and were able to coordinate. A Biden presidency is clearly going to work to restore the process of US alliances and the process of US working together. So whatever happens, I think will be more coordinated than what we've seen in the last 3.5 years. The other part of the dialogue around US foreign policy from, I think, people who want to be in the next administration has been to say, hey, look, the only tool that the US has had in the last few years in terms of foreign policy has been sanctions. And whether the story was Russia or whether the story was Iran, all the US has done is, or Venezuela, we've imposed sanctions. And it kind of hasn't worked. So we need to find different policy tools. I think what you might see in a Biden administration is less reliance on sanctions and more other tools. Now, it's hard for me to know ex ante what those tools would be, particularly in the Russia context, but I think you're going to see US foreign policy expressed a little bit differently than it's been in the last sort of 5 years. There's a sense that sanctions just kind of don't work. We got to find something different.
Thank you. So back to questions from the chat. One question you basically addressed about lower yield, low discount rates, and you already told us that they support valuations. And the questions, again, what do you expect from Fed policy? You already addressed that in the beginning, that it's low as far as we can see. And a new question, is oil price a smaller driver for the Russian market now than it was 5-6 years ago?
Yes and no. I think the yes would be essentially with the stabilization mechanism and with the CBR intervening and essentially trying to balance out the oil-related inflows. I think it's clearly less of a day-to-day influence than it was in sort of 2013 to 16. And I think that's positive. I think Russia's built up reserves. It's delinked itself to a large extent from the Eurobond market. Russian companies are borrowing less abroad. So in that sense, the oil price is less of an impact day to day. Over the medium to long term, you know, oil and gas are 2/3 of exports. It's a huge chunk of government revenues. It matters a lot. And so, you know, one way to think about this is, and this is, well, the comparison is Nigeria versus Saudi. So Nigeria has like no reserves. And so if you think about the thought experiment as what would happen if the oil price went to 0 for a week, and then everybody knew at the end of the week it would go back to 45, Nigeria would panic. There's no reserves. We don't have any money for a week. This is horrendous. In Saudi has enough reserves. if the oil price goes to zero for a week, nobody's really going to notice. It has a pegged currency. Nobody's really going to notice. I think where Russia was in late 2014 and 15 was closer to the Nigeria part of the very sensitive to oil prices on a day-to-day basis, and it's moved to be a little bit more boring like Saudi. However, the reliance on hydrocarbons in the export mix, in the government revenue mix, is still big. And so over the medium to long term, oil prices still matter a lot.
Thanks a lot for this question. And I want to come back to the US market again. What's interesting, the influx of new retail investors like Robinhood kind of investors who basically can trade all sorts of things from their smartphones, having absolutely no clue about what they're trading, like can trade options. So how does this impact the market structure and behavior? What do you think about that?
You know, as a JP Morgan employee, we're not allowed to say naughty words. We're not allowed to say that some investors are just flat out crazy. But there are very few people who trade stocks successfully part-time from their phone over the long term. I think ultimately this looks and smells like something that's going to end up badly for a lot of these investors. And that's a shame. In terms of influencing the market structure, I think it's had some impact. And I know that our flows and liquidity team, which does a huge amount of work on this, has said there is some noticeable impact on pricing, especially around the tech sector and a few darling stocks. I don't think in 2 years we're going to be talking as much about Robinhood as we are now. I don't think this is a permanent change. But I think to the extent it is something, it's probably something worrying overall for the market structure. Stock markets need investors that are serious, detail-oriented, focused on the long term, and that's not really Robinhood.
I see. And another question about Fed, and I just make it short. Basically, is there any possibility on the horizon that at some point Fed starts shrinking balance again? So what are the conditions, and when can we possibly expect that?
I mean, I think what the Fed is really trying to tell us is, hey, look, we are going to stay easy until inflation goes above 2 for a while. Now, how we interpret this in terms of rates and the balance sheet, I don't know. It does seem like maybe in 2022, 23, 24, we're going to be moving towards a little bit of fiscal consolidation in the US, which might reduce the need for Fed to be buying government bonds. On the other hand, if we do see some amount of fiscal consolidation in the US, we are going to want to offset that with ongoing monetary stimulus. I guess what I would say is the Fed's probably going to keep buying bonds, keep doing QE until there's a sense that we're getting much closer to closing the output cap. And there's also, I think, going to be some discussion within the Fed about how is what the Fed doing with its balance sheet, how does that relate to fiscal policy and the issuance from the Treasury? So it's not something I'm going to worry about for the next couple of years.
I understand. And thank you very much, David. So it's exactly the time we finished. It was amazing. It was very interesting. It's actually rare, I'm sure, rare opportunities for many people present here to have an access to such an expertise. And we're very happy to have you tonight. Thank you very much, and goodbye, everyone.
Thanks, Pavel. Take care.
Bye.